Welcome back to Midcap Radar. Facilities management services company Krystal Integrated Services reported a strong top-line growth of 52% in Q4. Net profit also grew 69% on a yearly basis. Sanjay Dighe, the CEO and whole-time director, is joining us now to discuss further. Good afternoon, Mr. Dighe. Thank you so much for joining us for this particular interview. First up, give us a sense. Q4, growth has been exceptional, almost 52%. FY24, it's been a 45% growth. Is this sustainable going into FY25? What is it that you're penciling in for FY25? Should we moderate our expectations?
Good afternoon to you. Thank you, first of all, for having me here. It's always a pleasure to speak with you. We've done very well in our Q4 results and also the quarter-ending numbers. Yes, this is our trend. We've already said that we are very much in our zone that we've been talking about in terms of our top line as well as our EBITDA margins. So I'm not surprised with these numbers. This is ideally the zone that we will operate on. And going forward also, we will have such numbers continuing as the quarter progresses.
Okay, so you'll continue to grow in that high double digit, or I would say around 50% is what you grew in Q4. What about margins, Mr. Dighe? Because in FY24, margins declined by 30 basis points to 6.7%. What kind of margin trajectory are you looking at in FY25? Would it also be led by change in your product mix? Which out of the three segments has the highest margins for you?
That's a good question. The margin profile, as I said, will remain the same. And product mix of our IFMS and staffing services, security services, and the catering also more or less remains in that zone. But of late in the last quarter also, or in the second half of the last year, we had good organic growth coming in our staffing segment. So I think that segment has grown. But answering your question about the margin profile, IFMS always has a better margin profile because it is bundled services, and then it is followed by the staffing and the staffing services. So we plan to acquire good businesses in the IFMS domain nationally. We are having good pipeline on which the sales team is working, and we are very confident to move ahead in our IFMS space as well. Not letting the security services remain in that 10% kind of a zone. We are expecting to grow that segment also very properly. We have a focus there. And on a national level, there is a lot of activities and new establishments coming up where security services are required. So we are very focused on that as well. So all these four segments, we have independent focus and we aspire to grow them.
Mr. Dighe, if you could give us a sense of sensitivity analysis as far as the entire revenue mix is concerned. Facility management FY21 was 70%, now come down to 54%. Staffing has gone up from 15% to almost 31%. So you're saying that the revenue mix is improving. FY25 end, what will be the revenue mix amongst these four segments that you're present in? And also, does the staffing segment enjoy higher margins?
Okay, so there are a couple of questions in one question that you have asked me. So the staffing, in terms of profit margins, IFMS continues to have a better margin profile. Staffing services follows. It all depends on how your contracts are structured. The contracts that we are also aspiring and we focus on are margin based. So it is a margin based contract in terms of management fees. So we are able to extract good margin in our staffing business also. And also a very significant quantum of our staffing business currently comes from our government customer. So there the profile is a little better definitely from a corporate staffing business. So overall, if you ask me, continuing in the next quarters also that we have a great pipeline. We are very soon we will be acquiring good businesses also. And also there is kind of sunny side up. There are a lot of companies in India and abroad who have technology in our domain, who have different products that they are also after listing, they are eyeing us. A lot of people are meeting us to see how we can use their products in our services, whether it is IFMS or in bundled services. Now we are having good discussions with them. So if everything works well, then our margin profile will definitely be better.
Okay. So I'll come to that margin question in just a bit. You mentioned government contracts coming in, especially for staffing. What is it as a percentage of your overall order book or revenue contribution right now? Have you made progress to reduce reliance and improve private sector work? Because it was around 76% during the IPO time.
Yeah, generally the revenue mix is 70-30. That has been how it is traditionally. But as you also would know, the government business comes in higher volumes than the corporate business. So if you acquire one particular government contract, then all of a sudden that 70 would surge to 76, the way that it has happened during our listing. But that doesn't mean that we are not going to be focused on the corporate. We are absolutely focused on the corporate. We have revamped our team on national basis to come and have this margin profile. Aspiration is to keep it 70-30, which is a general aspiration. But we are not sad if it is 76 because it adds to our margin, it adds to our revenue. Also, a government business adds to a complete 3 years of pipeline. So it is a good thing. But at the same time, our aspiration is to maintain it into this 70 to 75 and 30 to kind of.
70. All right.
Yeah.
Okay, Mr. Dighe, thank you so much for joining us today and speaking with us. So that's the word coming in from Krystal Integrated Services. Strong end to FY24. They expect the momentum to continue in FY25 as well. But quickly taking a look at the market.